I'm Amanda Brown-Nairman, the Executive Director of GoFundMe.org. You're watching Taking Stock, and that's hot.
Let's do it, folks. Time to rock and roll. 2 minutes to go into the close here on this Tuesday, March 10th, on the trading floor of the New York Stock Exchange. Investors continuing to try and digest the latest conflict out of Iran and the Middle East. Relatively muted price action across the tape today. We are expected to see the major market indexes finish in the red, at least fractionally, though a bit more reminiscent of a traditional risk-on type of day today, with technology, discretionary, and materials, your three strongest performing sectors in the S&P 500 for this Tuesday, and your laggards, including energy, healthcare, as well as utilities. Welcome to the show, one and all. You're watching Taking Stock. I'm your host today, JD Durkin, here on the trading floor of the iconic NYSE, just moments away from the ringing of the closing bell. The team from Bunge, this is ticker symbol BG, set to do the honors in just a few moments. The VIX, overall volatility in retreat, with yields kind of split across the board at this hour. The 10-year Treasury yield up only 5 basis points, back to a relatively elevated level of 4.15. The dollar relatively flat. Gold and silver both up on the day, but only about 1%. Far more muted gains than the historic run-up they've had over the course of the last several months. The cryptocurrency majors all up in positive territory, with Bitcoin reclaiming the 70,000 level. Our good friend, longtime trader here at the NYSE, Tim Anderson's on deck. He'll join us right after the bell. We'll continue on with our ongoing market coverage on this Tuesday, March 10th, after the closing bell. I always love when people hit the gavel. Don't just hit the gavel, but hit it with some authority. Your final tail of the tape on this Tuesday, March 10th. The S&P 500 down 0.2%. The Dow down 0.07%, down essentially unchanged. The New York Stock Exchange Composite Index down 0.3, and the small caps down 0.2 as well. Most of the Mag 7 tech stocks were up on the day. The big gainer, Nvidia, up 1%. Microsoft shares selling off 1% as well. Cisco, 3M, and Caterpillar, those are your three strongest performing Dow components. Your Dow laggards, Boeing, Salesforce, and Chevron. And over the next half hour, we'll keep our eyes very closely locked on Oracle. They are set to report quarterly results really in just the next few minutes. We'll be looking for the latest on cloud demand, enterprise software budgets, and much more for the tech giant. Shares of Oracle down 23% so far here in 2026. Let's bring in the man himself, Tim Anderson, Managing Director at TJM Investments, longtime big board veteran. Welcome back to Taking Stock, my man.
Thank you so much for having me on such an action-packed day.
Well, you're not kidding, but you and I were talking earlier trying to determine what the action actually is. Are investors sort of just sitting on the sidelines? What are they rotating into, if anything? Or is everyone kind of in wait-and-see mode as we wait to see the latest out of the Middle East?
I think that even though we're in a very news-rich environment and people are waiting for definitive headlines, not just rumors, that they're still looking to move their positions around a little bit, add things that are being sold indiscriminately, maybe trim some of their larger positions that are having little price spikes from time to time. And we're having, while they're still looking to figure out what the larger moves might be. We've had very sharp moves on an intraday basis and on an overnight day-to-day basis in oil and in some tech names and in some natural resource and mineral and mining stocks. Mm-hmm. And I think investors are moving their positions around accordingly, but still looking for much more clarity on how many more weeks or days the war, if you want to call it that, will still go on, and then what the landscape will look like after that.
Yeah, what are you tracking in terms of the oil markets? It's a big drop here. We got here at the big board in front of us for West Texas, down 8 points. Brent down 8 points. It's a big drop, but of course it's a big drop relative to a huge spike that we had for the oil benchmarks, both in the U.S. and around the world, and that translates directly to an increase in gas prices that all U.S. consumers are facing at the pump.
Right. And clearly oil spiked up to 120 Sunday night, Monday morning. And a lot of that spike has gone away. So we need to just see what the next definitive moves are in terms of this $20 billion insurance fund that's being set up between the U.S. Treasury and an international group, let's call it that doesn't have a total definition behind it yet, and also to what degree the U.S. military will be escorting oil tankers through the strait. There was an erroneous report early in the day that had already happened. Then they retracted it, but oil did not have a sharp spike really after that retraction, although it came back a little bit from the high 70s to maybe the low 80s. So there is a little bit of movement to every little story that we get out of the U.S.-Israel-Iran conflict.
Oh, yeah.
But I don't think that, I think a lot of these are being, the real big money is not making any substantial moves without a real definition behind the facts.
Of course, I got less than a minute left. What does all this mean for the Fed? We do have an FOMC meeting, a two-day policy meeting next week. What do you think their considerations look like, Tim?
I think that the Fed will try as hard as they can to say that they don't want to be influenced by short-term price spikes in oil or any other commodity. And of course, they can always fall back on their most favored inflation metric is ex-food and energy. Mm-hmm. So I think that they are going to say that they don't want to react to short-term price spikes or price plunges in any commodities that are components for inflation. They're more focused on the longer-term macro trends. So they'll be looking at CPI, and then we get another. We get their favored PCE number later in the week.
Yeah.
That's what they're going to really try to focus in.
Yeah, of course. We got the CPI number tomorrow, PCE, the all-important core PCE, out Friday morning, that two-day policy meeting. Tuesday, we got the decision. Wednesday, one of Jay Powell's final press conferences as well. So we'll see what Mr. Powell has to say.
And so I think also that all of this volatility gives them the perfect pass to pass.
Right.
Let's say.
Right, the pass to pass.
The pass to pass. Because they don't want to make a decision that is at all influenced by near-term volatility.
Yes, absolutely. All right, Tim Anderson, Managing Director at TJM Investments. Thanks for being here as always, my man.
Thank
nice
you
to have
so
you
much.
kicking off the broadcast. Josh will grab your mic. Howie, you and I will head this way. We're bringing you the latest analyst calls here on the day. First up, Wedbush analyst reiterating Apple has outperformed. They call Apple, the tech giant, a top name to own in your portfolio right now, saying the product portfolio remains strong given the momentum with the iPhone 17 upgrade cycle and what they call a monster cash flow. Next up, TD Cowen upgrading Rivian to buy from hold. They say we are bullish on the debut of what's known as Rivian's R2. That's the new electric SUV model, midsize that is, suggesting additional upside potential, although shares are down 15% on the year. Finally, Wolf analysts reiterating Amazon as outperformed, boosting the price target up to $255, pointing to accelerating AWS growth and robust retail growth, although shares of AMZN are down about 7% so far here, year to date. Speaking of being down year to date, we'll take a look here at Novo Nordisk and Elevance Health, two NYSE notables. First up, NVO, down more than 2.5% on the day, getting a downgrade from analysts at TD Cowen, calling it an innovative company that deserves credit for unlocking the potential of the obesity market, but saying this company still faces enormous challenges. As you can see there on the screen, trading down to $38.72 a share, down 2.6% on this Tuesday trading session here on Wall Street. And Howie, let's take a look here at Elevance Health, up 1.3% on the day. After the opening auction, this was actually one of the strongest performing names in the S&P earlier today, after reaffirming the company's 2026 guidance. Up today, but shares of Elevance still down about 18% from the start of the year. And now Money 2020's very own Scarlett Sieber brings you yet another edition of Jargon Translator, taking all of the wonky, complicated parts of financial jargon and making it make sense just a little bit more for all of you watching at home. Take a look.
Welcome back. I'm Scarlett Sieber from Money 2020, and this is Jargon Translator, the segment where we make bond math sound slightly less like a sleep aid. Bond people love to sound calm, but duration risk is the reason they quietly stress sweat through rate hikes, and we have some of those. Today's term, duration risk. Duration risk is the idea that the longer you hold a bond, the more sensitive it is to interest rate changes. Think of it like dating someone for a long time. The more invested you are, the more dramatic the swing feels. Here's the real story. Duration measures how much the price of bond will move when interest rates move. Higher duration, bigger price swings. Lower duration, less drama. Why does this matter? Because when interest rates rise, existing bonds become less attractive and their prices drop. Long duration bonds take the biggest hit. It's basically the market saying, I could commit to you for 30 years, but I'd really rather not. This is why banks, asset managers, and risk teams obsess over duration. One bad rate move and a safe portfolio suddenly looks like a roller coaster nobody signed up for. Duration risk, the reminder that even in fixed income, nothing is ever truly fixed. And that is your jargon translated. Have a term you want us to break down? Drop it in the comments below and it just might make the cut. Back over to you.
Welcome back to the show. Time for the latest headlines in the world of startups, raises, and rounds for your Tuesday afternoon here on Wall Street. First up, sleep tech startup 8 Sleep raising $50 million in a strategic round led by Tether Investments, valuing the company at $1.5 billion. This comes as the firm pushes into AI-driven health products and FDA-tracked sleep technology. Next up, AI platform Rospace raising $50 million led by Sequoia in order to help private equity and hedge funds turn years of fragmented proprietary data into actionable insights, with 7-figure contracts already lined up by many top firms. And finally, Swedish legal AI startup Legora raising $550 million in a fresh funding round that values the firm at more than $5.5 billion as it pushes to expand in the U.S. and capitalize on booming demand for AI tools that help lawyers review documents and draft contracts. Appropriately so, joining the broadcast at this hour, David Eckstein is the CFO at the aforementioned Legora. He joins us now down here on the trading floor of the big board. Welcome and congratulations on all the success.
Thank you, JD. Thanks for having me.
Let's start there with that last headline that we just brought our viewers. Talk to me about what this now allows the firm to do that maybe you could not quite do before.
We were seeing unbelievable demand in this round. We had over $1 billion of demand. We're seeing incredible conviction for legal AI. The world is changing around these new workflows, and the legal AI space is broader than the $40 billion in legal services. It actually touches all $1 trillion in the human services space. And so investors leaned in, and we're very excited to welcome Excel Partners, who led this $550 million round at a $5.5 billion valuation. And we're also welcoming back all of our existing investors, including Benchmark, Bessemer, Redpoint, Iconic, General Catalyst, Y Combinator, as well as a dozen new investors, including Airtree, Alkion, Geodesic, Bancap Venture Partners, and the list goes on from there.
Yeah, the firm is based in Sweden, but you are certainly a global enterprise to say the least. What specifically are you seeing here in the United States market that most excites you right now here at home?
It's so funny because this round comes on the 1-year anniversary of our entrance to the US market. And in just one short year, the US has actually become our largest market by revenue. And in that 1 year, we've grown from 200 customers to 800 customers globally, from 20 countries to over 50 countries. But the US market has something very special going on. The second mover position that we're in is actually more powerful than the first mover advantage. And what we're seeing is very similar to what RAM did to Brex and Databricks is doing to Snowflake. And we're benefiting from a number of big wins and rips, including Goodwin, Cleary Gottlieb, Cooley, Debevoise, and it's just getting started. Last year alone, we saw 17x growth on the top line.
That's amazing. David, are you still seeing many legal firms sort of experiment with artificial intelligence, or in your expertise, have you already seen the adoption, like the real admittance that this is the future and now is the time to adopt a lot of these tools, even if many of them, I'd imagine, had a healthy degree of skepticism to embrace these new AI-based tools?
We have seen a structural change in the way that these legal firms are adopting AI. If you think about it, there's 600 million people every single day that depend on AI, and the enterprise TAM alone in the past year has grown 10x to over $50 billion. We are beyond the chasm. Today, legal firms and internal legal departments are embracing these new capabilities and working it into their critical workflows. And Legora is the key platform that's driving this transformation.
Before I let you go, from more of a financial perspective, how do you balance aggressive global scaling with a disciplined approach to overall growth?
Legora has always been disciplined and will always continue to be disciplined. The not well-known secret is Legora has burned very little cash. To date, Legora has burned less than $50 million. And Legora still has every single dollar of its Series C in the bank, which means that Legora has roughly $750 million in the bank post this round. We have a lot of runway. We have a lot of cash to make very calculated, very disciplined decisions. And so when we think about making these decisions, we always start out with an ROI. What do we want to achieve? How do we want to grow? And as we think about this year in particular, we're going to be growing to over 300 headcount in the US. We're already at 4 offices in the US, and we're going to continue to expand. We're going to grow our total headcount around the world from 300 headcount to 900 headcount. It comes down to making the right decisions. And so we benefit from some of the best-in-class metrics, including a 10-month payback period, a 6-figure average contract value, and the list goes on from there. But what got investors the most excited in this round is the user engagement, which has tripled since January and is on par with the amount of time spent writing emails every single day. What I will tell you is we are just getting started.
David Eckstein, CFO at Legora, just getting started. That's the way you end an interview. My man, thanks for being here. Nice to have you.
Thank you.
All right, folks, don't go anywhere. Much more Taking Stock coming up after this. Welcome back to the show. Rand Grushkowski joins us now via Zoom. He is the co-founder and CEO of MassPay. Rand, it is great to have you here joining this Taking Stock broadcast on this Tuesday. Talk to me about the key problems that you see your firm solving for marketplaces as well as gig platforms.
Well, thank you for having me, JD. MassPay is really helping businesses that care about people getting paid. You have a lot of companies that pay contractors or third parties, and frankly, they don't care about them getting paid fast or efficiently. We change it. We work with companies that believe that getting people paid efficiently, in a timely manner, in the way that they want to get paid all over the world is integral to their success. And that's what we've been doing for the last 6 years, really serving a lot of different types of verticals. Marketplaces is one of them, because marketplaces, it's an integral part of the product. Getting people on the send side and the receive side paying efficiently.
Rand, talk to me about who some of your biggest customers are and what are their biggest pain points that they're coming to you with to help solve.
So one of our large examples is WAP. Most recently raised $200 million from Tether, great partner of ours. Marketplace needs to pay sellers all over the world. We help them scale it, essentially getting people paid efficiently, but also in the way that they want to get paid. So whether it's crypto, stable coins, cash pickup locations, however people want to get paid, that's how we get it done.
Yeah, it's all about lowering latency, trying to expedite the process of these payments. How quickly can these payments now go through from companies to their workers around the world?
So real time is definitely how we want to push things, but it's also where the demand is going towards. People are trying to get access to their cash as soon as possible. So in the US, obviously, we learn about RTP, FedNow, Venmo, but those kind of rails exist now all over the world, and we are making it available for our clients at scale. So real time is definitely where we're pushing, and so we can see demand is growing with WAP and many other clients as well.
Are there specific industries that you think need these sort of low latency, cross-border effective payments more so than any others right now?
Yes, primarily industries that serve small businesses. When this is the primary source of income for individuals, or even secondary income, but something to depend on, people want to get paid fast. And real-time availability of funds is important. That's why you see industries like earned wage access is really picking up because people are looking to access their earned money as soon as possible. Offering it across the world in different rails is not an easy task. We've built over in the last 5-6 years, tremendous infrastructure, more than 70 correspondents globally, 14 sponsor banks just in the US alone. We have a partnership with Visa on the Visa Direct. We are an enabler for the Visa Direct platforms, making it really accessible for people to access money across different channels, so they can access the money as soon as possible and utilize it in their lives.
Rand, I'm almost out of time. Quickly, if you can, before I let you go, talk to me about some of the ways the gig economy is changing overall payments infrastructure.
Well, gig economy, obviously, especially as the economy is trending, people are looking for additional sources of income. So where somebody used to have a W-2 before, now they have a W-2 and a 1099, generating supplemental income. Again, people are looking to get access to money instantly. Most of the payment systems, legacy payment systems, especially on the payout side, which is where MassPay operates, were not operating for speed. It was just to get the money there. So there's definitely now a growing demand for real time, and the payment infrastructure have to evolve to support it. In the US alone, we see growing fragmentation of payments. You have RTP, you have FedNow, you have Zelle, you have Venmo. We see the same trend all over the world, and a lot of it is being driven by gig economy and people looking to access, call it smaller transactions in real time.
Rand Grishkowski, co-founder, CEO of MassPay. Rand, thanks for being here. Nice to have you. Don't go anywhere. Folks watching at home, more Taking Stock coming up after this.
Well, let's get to the big story breakdown. After a robust 2025 where global equity markets defied expectations, 2026 has opened with plenty of volatility. Now, the leaders of the market have changed. U.S. large cap stocks posted solid gains last year, and international equities and emerging markets are materially outperforming. But do investors need to look overseas for better risk adjusted returns? And how is the opportunity set shifting? Well, joining me on this Friday morning following that U.S. jobs report is Stephen Schoenfeld, CEO of Market Vector Indexes. Stephen, good morning. Thank you so
Good
much for
morning.
joining me.
My pleasure.
Well, it has been quite the week across all asset classes. We continue to look at U.S. stock futures in the red, but this does come on the heels of that U.S. job report. So we got that surprise of pullback in non-farm payrolls and unemployment rate ticking higher to 4.4%. So what does that mean for the economy and the Fed?
So it was definitely a negative surprise. Most analysts expected a positive number at least. To me, it gives us a little bit of a fear of stagflation. We have oil up and economy down. It is not being reacted well by the market. Right now, the futures pre-open are indicating over 1.5% drop. S&P has been in a range for almost 3 months. It's sort of absorbed everything that has hit it. But this could be the straw that breaks the camel's back. Uh, Big tech has been hurt even more. And even though there were hopes for a strong start to 26, it seems like those are diminished. And that's why I believe there's more opportunity abroad.
Yeah, and of course, we're keeping a close eye on energy prices. So we've seen both WTI and Brent prices skyrocket this week as the escalating tensions in the Middle East remain top of mind for all of us. But what does that really mean for inflation?
So the first economies that are going to be hit are those who are fully dependent on Mideast oil. So that's more China, more Europe, more India. U.S. is a net oil exporter, but oil is a global market, and we feel it at the pump. We see it in the headlines. It's not just gasoline; it's also heating oil. Winter is not over, although hopefully it is soon, and we go to daylight savings time this weekend. So I do think it's one of those headline numbers that spark not just economist fears, but actual average citizens feel it.
Mhm. Yeah, and I do want to get your take on what we're seeing in global equity markets. And as you mentioned, depending on the economy, depending on the nation state and the region in the world, each nation is affected differently by the conflict that is unfolding in the Middle East. So, what does this mean for the equity indexes, especially since we saw that outperformance in 2025? But this year, can we continue that?
So the shift to international equities or non-US outperforming in 2025 was very significant, more than double the return of the US. Already this year, going into March, it was repeating. So you had international equities, including emerging markets, outperforming. Of course, with the US-Israeli attack on Iran and what is happening in the Gulf and how Iran is lashing out at the Gulf oil producing, it's creating turmoil across markets, especially oil and energy importing. But you still have standout markets that are more independent. Brazil is very promising. It's energy independent and the economy is more in an upswing. Surprisingly, this year, Israel has actually rallied in this last week because people are seeing a diminishment of political risk and existential risk. So investors need to be selective, but I still believe strongly that non-US will be a place for diversification for US investors.
Yes, and expanding on what you just said, we have been seeing sharp pullbacks in certain equity markets while rallying to new record highs in other markets. But I do want to ask you about the role of the US currency in all of this, especially given what we're seeing across all asset classes.
Yeah. So the US dollar was on a weakening trend all the way through late February. But as this crisis unfolded, to the surprise of many, the dollar has strengthened. I think people see the geopolitical strength of the US, and the dollar is still a safe haven currency. I don't think we're going to have a full turn and a bullish dollar environment. But when you have headlines in both Barron's and The Economist of the dollar being dead, that's usually a good contrarian sign to consider holding some dollars.
Well, Stephen, we will have to leave it there for today, but a lot of moving parts for Americans to digest on this Friday morning. So thank you so much for joining us.
Thank you.
Thank
Great
you.
to be here.
Hello and goodbye. We'll see you tomorrow.